Hi, everybody. Thank you so much for being here today. Welcome to episode 3 of our How to Scale Your MSP Without Pulling Your Hair Out series. This one is all about mergers and acquisitions. So just a couple of housekeeping things. You'll see down at the bottom, there's a place for Ask a Question. So if you have a question that you want to go ahead and throw up there for our panel, you can. We will have about 10 to 15 minutes at the end for Q&A. But just please keep the conversation going. We want this to feel super social, and we want you to feel like you're a part of this discussion. Of course, we're going to be joined by some amazing panelists today. But first, I'd like to introduce you to the CFO of Liongard, Josh Tabin, who is going to talk to you about how you can maximize your MSP's potential for being acquired. All right, Josh, I'm going to give it over to you.
Thank you, Cynthia. I'm excited to talk with everyone today about mergers and acquisitions, and I don't mean that facetiously. So we've covered 3 different ways to grow your managed service business as part of this series. First we started talking about how to find new business. Then we covered how to retain and grow existing relationships. And today we're going to cover merging and acquiring with other MSPs. Now we're going to start off by showing you how to maximize your potential for being acquired. Reason to focus on this is that most companies that are doing acquisitions are typically larger, more mature companies that have a lot of experience, tools, people to be able to do this. So we're going to have a quick dialogue about that, and then we're going to be followed by a panel of M&A experts that will talk through a few M&A topics, and finally we'll do some Q&A, and we'll do that live. So let's dive in. So according to Channel E2E, there were over 530 M&A deals completed in 2020. So have you considered your exit strategy? And if you're interested in being acquired, you need to optimize every aspect of your MSP in order to be acquired. So let's explore the 3 key areas together. So first, when we talk about the key areas, it's important to really focus on the financial aspects of it, because ultimately a transaction that is completed is done mostly for some financial reason. You acquire to get bigger, to become more profitable, to get to a certain financial outcome for yourself. One of the key things about financial aspect of being acquired is it's important to make sure that your company is set up to be most attractive to acquirers. And one of the ways to do that is to start shifting your business to more of a recurring revenue model or managed services versus time and material. And the reason for this is that this provides some predictable revenue understanding for people who are looking to buy the business so that they know what they're getting. Time and material project business is great. And by nature, it is not something that is always consistent. It may be reoccurring, but that's different than recurring revenue. Recurring revenue is something that by contract happens every single month. So the more you can shift business to a recurring revenue model, the better. And it's typically valued higher than one-time revenue. Another piece that's important from a financial perspective is cleaning your accounting or just cleaning your books up is really important. In my experience, when someone comes and offers you a term sheet to acquire your business, it's a starting point, and that number is usually the highest number they're willing to pay for your business based on what they know at that point in time. And then they come in after you agree to it and they start doing diligence, and the number goes down here and down here and down here as they find things that are within your business that are not the way they expected. Typically, it's important to understand that although you may record things a certain way, typically larger companies tend to follow what's called GAAP, or generally accepted accounting principles. And as a byproduct of that, you want to make sure your accounting matches with GAAP methodology as much as possible, because that's ultimately what the byproduct of your acquiring your company to roll into theirs is going to look like. It doesn't really matter so much how you classify things. But ultimately what they want to understand is, are you doing the accounting in the proper way so that when they acquire your business, the financials that they're looking at are what they'll look like within their business. And it allows you the ability to maintain your valuation through the due diligence process. I think another piece that's really important, and I see cost of goods sold, Larry French. Thank you for that. Yeah, no, it's important to understand your economics of your business, right? How do you make money? Where do you make money? What kind of customers do you have? What kind of margins do you make on different products, services? What does it cost to support a ticket? What does it cost to service a customer? All of those things are important. And why are they important? Well, obviously, if I was an acquiring company, I would want to acquire a business that was more profitable than others. I'd want to learn why they're more profitable than other businesses. And I'd want to sort of acquire it, not just to get that business, but also to get some of the insight on how they're able to manage and support their customers more profitably maybe than other companies are. So the more that you can understand your own economics, help you think through how you can improve those. And ultimately, when a company is acquired, it's either based on a valuation multiple off of revenue, off of profits. And profits are usually done on what's called EBITDA, or earnings before interest, taxes, depreciation, and amortization. You've probably heard that term a gazillion times and may not know what it is. You can Google it. It'll give you the answer. But effectively, it's just a proxy for how much cash does your business actually produce after you bill out revenue. So it's important to know what your key metrics are. What are your staff data points? What are your staff to customer ratios? What are your SLA metrics? What kind of revenue growth or retention numbers you're seeing? A lot of acquirers, retention is a big part of it. And when we talk about retention, it's not just retaining the customer, but what is your net dollar retention? How much money are you making relative to where you started with that customer? Are you increasing your revenue over time with that relationship? So at its core, the financial section is really about just identifying as many pitfalls now as possible so that you really have an understanding for your business. And as you go through a diligence process and you share information within a data room, which is sort of the central repository for all of the things that an acquirer will look through as part of diligence, is that you can speak to them in a knowledgeable way and format, as well as showcase and highlight why your company is, in fact, better than others and why they should be looking to acquire you versus acquiring another company. The next piece of it is systems and processes. And as IT in general, IT is a very process-centric and technology system-centric function. And it doesn't necessarily mean that every process that you have is scalable, every system you have is fully integrated. It's important to identify where the scale points and integration points within your business, whether you've implemented those or not, are, so that as you talk to potential acquirers, they can find what we call in the biz synergies. Synergies is just sort of a consultant speak for ways to save money when I acquire. So if it's a cost that you have and as part of our merger or acquisition that we're going to discuss, that we can get the benefit of reducing those costs or increasing revenue. Those are what synergies are. So to the extent that you can identify and document as many as your processes and as many pieces of your business as possible, that's going to be really important. Now, obviously, Liongard is a great tool to be able to do that. It doesn't need to be super fancy as much as anything else. It definitely, though, needs to be documented enough that people can look at it, understand it, and recognize where the opportunities are. I think it's also important, even though you may have some unique culture and you may have some unique ways of doing things, it is important to try to leverage in best practices as much as possible, as well as best of breed software. And when I say that doesn't necessarily mean you have to go out and buy the most expensive, most commonly used software. What it means is try to avoid too many homegrown solutions or things that you develop yourself, only because those tend to be detractors of value in the form of an acquisition. I don't want to buy something or buy a business that I have to actually invest in continual development and maintenance versus something that's using off-the-shelf software that's readily available through other platforms and parties, and I don't have to take the ownership of continuing to monitor and maintain that. As well as having things that are there to facilitate a third party coming in and auditing those. And that's part of what due diligence is, a term you may have heard. It's in M&A interactions that comes up is really about how do I validate all the things that you told me prior to signing a term sheet with you are in fact correct. And if you have automation built within your infrastructure to be able to provide this very readily, it's going to speed the whole process up. And ultimately, another thing, as we say in the biz, is that time kills all deals. So it's very important to try to move the process forward as quick as possible. And I think finally, and this is a very underlooked one, but probably the most important piece of it, the reason most transactions fall apart is cultural. There's some sort of misalignment or failure to understand each other well enough that even though you make it to the point of consummating a transaction, it may be such that you don't realize the full potential of that transaction because things don't work out and you end up having to leave. So, we talk about doing what's called reverse due diligence. So if an acquirer is looking to buy you and they conduct due diligence on them as the company being acquired, do some due diligence on them, right? What are their, what does Glassdoor say about their employees? Are they happy? People like being there. What do vendors talk about? Are vendors, excited to work with this company? And the reason all this stuff is important is that a lot of times transactions have a component to it, which is called an earnout structure. An earnout is a way to say, hey, look, you're worth this much. I can only evaluate this much. I can bridge this gap, but you got to earn it later, which means you got to stay on for some period of time and help me make this successful in integration. Well, if the culture is not aligned, that's going to be very difficult to do. Okay. So, those are sort of the high level key pieces that I think are important to discuss and talk about. So with that, let's jump into the panel conversation. And at this point, let me turn it back over to Cynthia, who will do some introductions and we'll start having a chat. Cynthia?
All right. Great. Thank you so much, Josh. Okay. So I'm pleased to introduce you to, let's see who we've got up so far. First, I've got Clay Osland, who's the Chief Technology Officer over at Marco Technologies. I have Arlen Sorensen, who is the VP of Ecosystem Evangelism at ConnectWise, and Colin Knox, founder and CEO of Gradient MSP. And of course, I've already introduced Mr. Josh from Liongard. How is everyone today?
Doing well.
Doing awesome.
All right. Thank you so much for being here. I guess I probably never introduced myself. I'm Cynthia, the community manager at Liongard, if you're wondering. Okay, so let's start at the beginning with mergers and acquisitions. How do you search for companies that you might be interested in acquiring?
I can take that one.
All right.
We, at Marco here, we've got a large network of peer groups that we belong to. So we start with just letting people know that we're looking to acquire businesses, and that will oftentimes, that word will spread, and then we get people that call us saying, hey, we're maybe interested in selling our business. The other thing that we do is we work with our partners and let partners like Liongard and ConnectWise and others know, hey, we'd like to acquire some businesses maybe in these geographical areas or that look like this, and so they can help spread that word for us. And then we have a team of people that are dedicated to do cold calling. We're going to pick up the phone and just start calling people that own businesses and say, hey, have you ever thought about selling your business? And here's why you should sell to Marco. So we take a pretty wide variety, but it's really about trying to build that network and just letting people know that we want to acquire businesses. So if you want to get acquired, give us a call and we'll talk.
All right. Colin, you kind of look like you want to add something.
Yeah. So I can't talk about looking for the companies to acquire because we were never the acquisitive ones. But, I think what's equally important is identifying companies that could acquire you if you're looking to sell your business.
That was my next question.
And starting perfect. and starting to build those relationships and make sure that that the Marcos of the world are aware of you, right? And so some of the things that we did to make sure that we were on the radar of the acquisitive companies was we did regular press releases and we put those on the wire locally. So if we were signing a major contract or got a big client win, we'd put those on. Specific hires, we'd put those on. And that started to have the PE firms and other larger acquisitive organizations that watch those press releases in the regions that they're looking to acquire. They started reaching out and having conversations. And it was almost a way to track how we were doing and how active we were and what was going on with the business. And I think the other thing is there's a million benefits to going out and attending the industry conferences and trade shows and whatnot, obviously virtually right now, but we'll see when in-person comes back full on. But, there's a bunch of benefits. One of those is the networking and meeting a ton of the other companies who either were acquiring or ended up being acquired, and saying that they had a colleague in another region that was looking as well. So just getting yourself out there, always being open to the conversation, and making sure that there's as many ways for the companies to find you as possible.
I love that networking piece. I bet Arlen has something he would want to add to that too.
Yeah, I mean, I completely agree with both Clay and Colin. But the key to me is to be willing to let folks know that you are either buying or selling. I'm surprised at the number of partners that will call me and say, I'd like to sell my company. And when I say, well, who have you talked to? No one. Well, can I tell anybody about it? No. But I really want to sell my company. It's just a disconnect. We have to be willing to do the kinds of things Colin talked about and let people know who you are. And when the phone rings from a company like Marco, you got to take the call and have a conversation. So that's a key part of this, is just being willing to communicate about it and use all those resources to make that message known.
Well, and I know, like, we were at a previous MSP, one of those early members of HTG, I think HTG 3 back in the day.
Mm-hmm.
But even if you're not promoting that you're open to the conversation or looking to sell, the fact that you're in that peer group where there's the measure of accountability, you're sharing some financial benchmarks, you're having open conversation, those other participants are seeing the progression of your company, that's going to naturally spur some dialogue. And I can't even imagine how many deals have happened from just, people being in the same peer group together and identifying and watching and starting that conversation there with, somebody that's half qualified already now with due diligence to an extent.
Well, and Colin, that also leads to building a relationship before you start having those hard conversations, because diligence is it can be a daunting task, right? As an acquirer, it's our responsibility to our investors to make sure and uncover every possible rock. Not that it means we're not going to move forward with the transaction, but to assess risk, right? And if you have that established relationship of 2, 3, 4, 5 years of being in a peer group, you can pick up the phone and go, hey, we're seeing this. Give me the background. And it does, you come from a little bit more of a friendly path on that.
So, okay, that brings me to another question. So what would you say is the most effective way of understanding an MSP's business when you are looking to acquire them?
Data.
How do you get that data?
Good data. There's always, from my perspective, there's always a couple different parts of the business. Understanding if we're going to be a culture fit is certainly one aspect, because when we acquire a business, we need to make sure that the people that are there are going to be happy working with our culture, right? There has to be a culture fit. But more importantly, when it comes down to buying somebody's business, it is dollars and cents, right? Oftentimes, people that we acquire from have started the businesses, or they have poured their entire life, soul, everything into them, and so the dollars and cents are very important. And in order to get the most out of your company, the highest multiple, you need to have the things that were talked about earlier, and that you've got good EBITDA, you have strong margins, you can identify the people in your company that are key to the transaction. That's really important. And knowing your business, and if you don't know all the aspects of it, making sure that you bring a tight circle in early to have as those experts when we start those discussions is really critical.
Yeah, I think being able to tell your story is a critical part of the interaction as well. It's one thing to have the data, and that's critically important, and that's where benchmarking and peer groups can be a real asset. But you also have to be able to tell your story and explain how you got to where you are and what your vision of the future is, to see if there is that fit. And it's the biggest transaction that most owners are ever going to make, and they need to really prepare for it and then think about how they want to actually execute it before they get to it.
Yeah, having an idea, Arlen, you make a point, is understanding what the potential outcomes of selling your business are and thinking through those before you get into the thick of it is really important, because we'll sometimes talk to companies that go, hey, we want to sell our company, but they haven't thought about how that is going to happen, or what that might look like. And so those are things that then slow the process down. And as we mentioned earlier, time kills deals. So having that thought process or preparation ahead of time is important.
Well,
Yeah,
and
go ahead.
not even just having the information compiled, but verified to an extent. I mean, once you reach a certain size of your organization, like I think even when we hit $1 million in revenue, we started getting the audited financials, not the notice to reader, right? So not just how something's been gone, because one, your due diligence costs will come up, and I don't know how you guys do it at Marco or any of the ones that you did, Arlen, but we shared in the legal costs and due diligence costs and everything for our deal too. So cost is a consideration. If you're already paying and having audited financials, there's less questions, there's less, maybe skepticism in how things go. And just being prepped with that can take an early conversation to a closed deal way quicker.
Yeah, one thing I will add is I think Arlen's point is extremely important. And I can't tell you the number of transactions that went all the way to closing and didn't close because the seller of the business just really wasn't ready to let go of the business. And this happens a lot, not just in the MSP industry, but generally. And a lot of companies, a lot of MSP owners, I mean, this is their baby, right? I mean, this is part of their family. The employees are part of the family. And it's important before you even entertain this process to say, look, am I ready for something else? Because if you're not, don't waste your time, because it's going to be expensive. It's going to take a lot of your time and effort. It's going to be extremely emotionally draining on you. It's going to distract you and your key employees, whether you tell them or not. They're going to know about it from what's going on. And then you get there and you're like, oh, I'm not ready to get rid of this business. I still want to be part of it. And that is the most important hurdle to get over first. It's the emotional sort of hurdle of, am I ready to move on for something different? And I mean, there are consultants that just specifically work on just helping people just emotionally get past the fact that they may not own this business anymore, because going from being an owner to now being an employee within a company, that is a huge, huge transition. And my experience is most MSP founders are people that worked in IT, got tired of it, had this entrepreneurial seizure and said, I'm going to start an IT company, and built an MSP, and then realized, oh, wow, I just created 6 more jobs for myself now, right? And it becomes part of who they are, to the extent that when the time comes to sell, they're like, well, gosh, I don't even know what I would do with myself now. I'm not ready to give up all that stuff. So it's an excellent point, Arlen.
Well, just like you're basically like answering my questions before I can even get to them, because I was going to ask about describing that emotional aspect of being acquired and going through due diligence. And Colin, you looked like you had a very knowing expression on your face. What are you thinking about?
I don't think I was the only one. I saw the smirks that Arlen was putting out there. I mean, so I was very fortunate. When I sold my MSP, I had already exited the daily operations of that business. So that did make it a really quick deal, because I wasn't part of that, and clearly the business its success wasn't contingent on me. I agree, definitely making sure that you are ready to not be the key or sole decision maker for the organization anymore, that there will be decisions made that you do and don't agree with, that goes along with that. There is a big point about going from being that top dog of the organization to then becoming an employee. And that's something I experienced, with the exit of Passportal, and not necessarily a bad thing, but there's a definite change in dynamic that you need to adjust to, and a lot of business owners and leaders are alphas, right? And you like to be a little bit more dominant, you like to be more assertive, and you like to get your way. That's why you're in business for yourself today. But needing to have that ability and commitment, I think, more than anything, not just preparation, but commitment to eating that humble pie and realizing that you have a manager or boss now, and you do need to go with the flow of what's going on, in order to, better protect the success of that acquisition going well, because there are going to be some contingencies that you have to represent and warranty on the deal. But being prepared and set for that, and so that's why I think it was Clay that said it earlier. Is that culture fit is key, right? You need to understand and be prepared to go into war with those people and to work alongside and have some of those critical conversations when you're there. So.
And Arlen, from your perspective, what are some things that maybe that can make those emotional aspects of being acquired and going through due diligence easier? Because I would think that you've probably sort of held a lot of people's hands through these types of situations, right?
Yeah, I mean, emotion is a driver that you want to take out of the picture as early as possible. And, the thing that I learned and used in my acquisitions and sale were I had a non-negotiable list. I had a list of things that had to be true before I would be willing to transact a deal. And it became then more of a checklist kind of approach rather than an emotional kind of interaction. And that's the thing I encourage everybody to do is way before you even think about selling your company or buying a company, what are the non-negotiables that have to be true before I will do a deal?
Okay, and what sort of things would you put on a non-negotiable list then?
Well, it can be certainly price is one of those areas, but things like what's going to happen to my employees, what about my customers? I mean, it can be all kinds of different things that are important to you. But if you don't address those and get them on paper and then have that conversation, they come up at the last minute, like Josh talked about, and all of a sudden, well, you didn't tell me you weren't going to take all my people in the deal. Deal's off now, things like that. So I'm a big believer, because I'm sure everybody is getting calls all day, every day from Marco and others. Have the conversation early. Weed that stuff out way up front. You can spend your entire life just taking calls from people that might want to buy you. Don't let that happen. Use a list to help you sift through and just get to the people that actually are important and are really interested in doing it.
Well, and even making sure you have the conversations about those topics so that it's not a deal's closed and then it's like, what do you mean that's the transition plan? What do you mean this is what's happening with the, right? Because if it's not brought up, sometimes it doesn't get discussed, and it's not for ulterior motives of them hiding and let's sneak this fast one by them. It's just they're already going through a 300-point checklist of due diligence to make sure that they're going to mitigate their own risk and protect their investments. But I very much agree with that.
One thing that I think it's important, and I probably should have pointed it out in this section above too, is don't do it alone, right? Make sure you have some trusted advisors that you can work with. I mean, make sure you've got a good attorney, right, that really understands the nuances of what you're signing, what you're representing, what you're warrantying. That's really important. Have a tax advisor who can help you understand the tax consequences of doing transactions in different ways. I've seen people that have done deals that got hit with a huge tax bill later, and like, what's this all about? It's like, do your diligence up front. And I can't stress the value. I'm not necessarily advocating going out and getting a broker. I've seen some comments about people that use brokers, and I think there's all different types of brokers that are out there. And if you do, interview a lot and understand that you have someone who's really not just going to be there to sort of to help you find potential acquirers, but someone who's literally going to help you through the process. Right? It's, I love going to the gym, and I've been dabbling in working out for some 30, 40 years. Right. And it wasn't until I went out and hired a personal trainer that I actually stopped, messing around and actually started working out. Is because I realized that there was only so much that I can read and learn versus hiring a professional that does this day in, day out, who understands the nuances, who understands, where the current trends are, the current laws, the laws in the different states, as well as just, what are the things that I'm going to struggle with. That person is thinking through those and helping me work through that process all the way. Now, if you have a CFO or an operations person that maybe his experience has been through that can suffice as well too. It doesn't need to be an outside party. Just make sure you've got someone that's on your side that can, if nothing else, just talk through stuff with you, just so you can think through it verbally and out loud. Otherwise, selling a business can be a very, very lonely place if you don't have that team around you.
Josh, I'll make a comment. The tax consideration, it's surprising how often that's thought of, but we've had many deals fall through at the last minute, or on the flip side, get pushed quicker because of an unexpected or something that was found out about taxes. And so that's really good advice to understand that and have a really good tax professional help to understand, how deals can get structured. Is it an asset deal? Is it, how are we doing these to minimize that effect on the transaction? Because those are often things that either speed up or delay transactions.
And then going back to that list of non-negotiables, Clay, from your side of, actually acquiring MSPs, what are some of Marco's non-negotiables?
Oh, we acquire a variety of different businesses. So we've got lots of different product lines. I think we have to have cultural alignment, meaning when we look at a business, if everything that Marco brings to so what our value add is to our customers, we go evaluate a business and their value adds are completely different. They sell different products, they sell different services. If we can't bring them together in an effective way to get a benefit from the acquisition other than just a customer list, those would be things that we put on our non-negotiable list. So vendor alignment is a part of it. The sales and service strategies that we implement they don't have to be exact, but they have to at least be in alignment, right? I mean, that we can't, unless if we're trying to acquire a business to get into a new product line. I guess that'd probably be a different element. But those are some things. We prefer to have owners that can justify their EBITDA and show that it's going to have it's sustainable. So we didn't, the comment of like lipstick on a pig, right? They didn't just fire a bunch of people or eliminate a bunch of costs and then go, hey, look how great we are. We want to make sure that it's sustainable, right? And if there's going to be, if there's add backs that are taken into consideration on that EBITDA, like, hey, I'm the owner, I'm not going to stay on. Here's an add back for personal expenses. Have them documented, and actually have a like, if we ask the question, have the answer. And I think that there's no during the diligence process, a lot of people think you're trying to get like tricked into answering something. There's literally nobody's trying to trick anybody into anything. It's just we have to have complete understanding so we know how to fold a business in, what areas we need to focus on for risk. If you tell me your ERP system's amazing and then we find out it's not amazing, like those are the things that we want to catch up ahead of time so that we can plan for what investments do we need to make day one when we make the acquisition. And so I think it's just important to have good, and I used the word data earlier, but all that stuff that I just talked about, I pump into data, good understanding of your business.
Well, I think there's some good things that you added in there too that is probably very relevant for a selling or potentially selling MSP to recognize, is that the cost of the acquisition for the acquirer is not simply the amount of money that they wire to your bank account. Yeah. They're investing a significant sum of money in due diligence and the team of people and resources and counsel and everybody else to evaluate your business. And then after that, there's a considerable sum of money that goes into the whole integration and amalgamation planning and process and everything else, and doing what they can to protect their investment with the client's retention, employee retention, and everything. So, recognize and even respect that if you're going to go down this path with somebody, the amount of extra money that they're putting in that may not even result in a closed deal for them, which is what they're seeking, and understand even when they negotiate, on the price, that is part of what's coming into play, because they have to consider all those extra costs.
Yeah. I think that it also, there are different types of rationale for companies or organizations to acquire an MSP as well too, and understanding who you're talking to and what they want out of it is really important. One, besides the emotional piece as well too, what creators deals is just an unrealistic expectation about price and valuation. And a lot of people go, well, what's my company worth? Well, everything's worth something different. It's worth something different to different people who are looking to acquire it. For the most part, I'm not going to speak for what Marco's looking for, but at its core, I suspect they're looking to grow their top line. They're looking to expand into markets they're not into. They're looking to expand into verticals that they don't have as much of a presence into. Maybe add some, overproducing and overperforming aspects from a service line, from a product line perspective. And all of those are worth different amounts of money as well, too. But understanding that, that's what they're buying and there's a specific way to formulate value out of that, and having a realistic expectation of what it is that you'll sell for is going to help. I've advised folks that literally the first meeting I walk out, because what they want or they think they're going to sell the business for is just, it's never going to happen. And look, I'm not a prognosticator. I can't sort of predict the future. But if someone says, well, I want to sell for the 20 times revenue that company sold for, I can say, well, here's why that company sold for this much. And here's why I don't see you being able to sell for that much. Because different buyer, different purchase, different need, different size, different scale, different scope. So much of it's different. And you don't have to have a number in your head as much as just have a range, right? Because if you have a number if I don't get $19 million, I'm walking away from the deal. Well, it could be 18 and a whole bunch of other stuff that you didn't even consider that were really valuable that could make it even more meaningful, right? So this is all part of the process. And this is why I sort of talk about having someone to help you through it. Because I live in a bubble, in a silo very often, and I need people like Joe as a CEO. We get together once a week just to talk, and it provides perspective, right? And I need that perspective. And if you don't have perspective when you're doing this process, it's just going to make you frustrated. But ultimately, a company that's looking to acquire you is either looking to buy you as a platform to go out and buy more companies, and that's typically a private equity buyer, or it's an MSP that is really just looking to add geographic or vertical, or product diversity to what they do. And if it's one of the, I'm just adding top line, you're not going to get a high multiple off of that. So think about, what can I do differently to get a higher valuation? Because what I do is just different than everyone else. And that's one takeaway that I would say, is that how can you be a little bit different?
And I think you made a comment about having that, a trusted team you can work with, legal, finance, whatever that is. Be careful on the broker side. I know you said interview a lot of them. No offense to anybody that's ever sold a house or has hired a realtor, but I'll have 5 realtors come in and say your house is worth $1 million, but then we get 7 offers that are at $500,000. Well, who's wrong, right? More likely the broker, because the market's going to tell you what your business is worth, and it is going to be different. Like you said, we're looking in a certain geographic area that you're worth more money than somebody that's not in the geographic area, right? So there are aspects that can fine tune the number, but we're not going to be worlds apart from what the market speaks. And so just be careful on the advice you get. Don't pick a broker based on the number they just tell you you're worth, because there's too many variables to understand there.
Well, that's where understanding the motivations of everybody involved is so important, right? So understanding the motivations as to why a company may be looking to acquire. Is it service practice area, geographic? Is it market share, what have you? And then if you're working with a broker, an investment banker, whoever, generally they're compensated a percentage of the deal size. So they're going to tell you the higher price. So be reasonable, be realistic, find out how you can market yourself to the needs and motivations of the acquirers, right? If there are 1 million companies just like you in your region, well, the opportunity that they can not acquire you and acquire somebody else is there. So what makes you special, and what makes you more attractive or worth more to them, whether that's exclusive distribution rights to a certain technology or product, whether that's, a super long-term contract with a key client or franchise of clients that would suit very well in that they're interested in. So understanding that becomes very important to help you maximize the value and be the one that they choose.
And just to be clear, business broker does not equal investment banker. They're not the same thing. They're not. I mean, if there's one takeaway that I want anyone selling their business to know, a business broker and investment banker, 2 worlds apart, right? And if you can work with an investment banker versus a business broker, oh, that's a better value for you than a business broker. And I've got relatives who are business brokers, and nothing against them. They're wonderful, and it's not the same thing.
Yeah, but I think it's a critical point that you need to become a student of the market and understand what really is going on out there. And, I saw some research that said that the average seller in the SMB space of a business spends more time planning their last vacation than planning the sale of their business. And I think it's true. You need to become a student of what M&A is all about, no matter which side you're on, so that you understand the drivers that make a business worth more, because it does matter. A $5 million company can have lots of different values based on how they've positioned themselves, the kind of profitability they drive, and all those kind of things. And if you don't understand those levers, you're going to get what somebody offers you rather than creating what you want for an outcome.
Hey, Cynthia, do we have any questions from the attendees?
I've got one very specific about valuation. I wanted to go ahead and pop in here. This is from Tush, so thank you, Tush. What is a typical valuation for an MSP that is 95% recurring revenues for managed services with average customer contract term of 24 months?
What's the growth rate year over year?
Yeah, what's
average for 3 years if possible?
What's the how often do those 24-month contracts attrit, or do they stick around for another 24 months?
Yeah, the stock answer is it depends.
Yeah,
look, I think
somewhere between 1 and 10 times EBITDA.
Yeah, so I would say the market typically right now for just any sort of service business out there is somewhere in the 3 to 6 times EBITDA range is probably a wide berth. There are companies that will sell above that. There are companies that are not even worth that much as well too. So it's hard to specifically say, you're worth this much. I have a degree in finance, so I've taken classes on this stuff, and there's tons of spreadsheets and formulas and methodologies for valuing something. And I can have 5 analysts run 17 different models. It'll come up with 25 different answers for it. So I think the range typically is some sort of multiple on EBITDA that's anywhere in the, maybe 2 to 3 for bigger, faster growing companies, 3 to 5 for high growth, high margin, high profitable companies, and with specific segmentation. I think you can get maybe in the 5 to 6 range. And, and then the market will change from time to time as well. Sometimes the market will undervalue it. Sometimes it'll overvalue it. I would say, and this is, not to be unfair to Clay, but I think it's a hot market for MSPs right now. There's a lot of buyers that are out there. So I think if you have a company that is of decent size and is growing,
contract auto renew and growth rate is at 5% per year.
5% growth per year is not stellar, so it's not going to get you at the high end of the range. Double-digit growth will get you closer to the high end of the range, right? So single-digit growth, there's nothing wrong with it. It's attractive, right? But it's valued materially different. And without getting all academic, the formula that economists use for evaluation, that sort of all the modeling incorporates growth into the formula. So growth is an accelerator of value. The more a company grows, the more value it is. The more profitable it is, i.e. the more cash flow it creates, the more value it is. So if you have higher EBITDA margins, if you have higher growth, you're going to get a higher valuation, and bigger companies are more attractive than smaller companies. And the reason is and Clay will speak to this, the amount of time and effort to acquire a $1 million business is the same as buying a $10 million business, is the same as buying a $100 million business, is the same as buying a $1 billion business. So if I'm going to spend the same time and effort, I'd rather buy the bigger one because I'll get more bang for my buck out of it. And I'd have to buy 10 to make up this one deal, right? So being bigger helps, right? And that's why, companies are willing to pay more for bigger deals, because I can meet my whole quota for business development for the whole year by doing this one deal. So I do this, I'll pay a little bit more for it, because then I can just take the next 6 months off, which that's not real, but still.
To just add a little proof point on that, I don't know Clay's approach, but growth sells, because if it's super duper profitable, terrific. If it's not super duper profitable, they will find a way to make it super duper profitable. So I had an MSP that 3-year average was 30% growth. We did well. We got, a strong multiplier. I still have agreements that protect all that information, but let's just say we were near the top end of the ranges talked. I had a company that grew several 100% year over year for 5 years. That was a multiplier number that would blow your mind, right? So when you start to have those types of levels of growth, they will pay for that, because there's a secret sauce in there that they want to get, see if they can replicate that on other subsidiaries, on other business units, what have you, and make it more profitable on top of that. So growth is such a key important metric.
Yeah, and I think the other factor that we've kind of skirted around a little bit is, what's the desired outcome of that acquisition? Is it a platform company? Because that's today bringing the highest value in the marketplace, a company that they can buy and then plug others into over time. Is it a strategic alignment company sale, where that's what we did with ConnectWise? We positioned ourselves to be a ConnectWise acquisition and worked on that for several years to make sure we had the relationships, the alignment, all the things to make it easy. And it was good for both sides when we made that acquisition occur. So there's a lot of factors, and what Josh said is right. It depends, but you can control a lot of the it depends if you plan ahead and really work at it. And the last thing you should do is just make a snap decision that, I need to sell my company next week. Let's see what I can get. It takes, I think, 2 to 3 years to really get ready to sell your company at the top of the range.
And I think the most important thing here is just to be realistic about valuations. We're gonna spend the time to make a deal happen with those that are in it to make a deal. People that, like, you mentioned earlier that you walk out of the first meeting, Josh, is, if you set unrealistic expectations, we're just going to move on, right? And it's because
you can't make money. You can't make money, Clay, if you're overpaying for stuff all the time, right? I mean, It's just, go to a flea market and you'll understand how price and value really works. It's I can only buy it for so much and I can only sell it for this much, and somewhere in between those numbers is the right number. And I think it's I actually think, what Arlen said is really important, is to have sort of an idea on what you want going into this. Because if someone makes you an offer and it's nowhere near the range of what you want and what you think you want is realistic, don't waste your time anymore, right? Because, big gaps you're not going to make up, right? If you go into it going, oh, I know they're at 10 right now and I think I can get them to 20. No, it's not going to happen. You can make up small gaps here and there, but for the most part, if you're far apart, move on to something else.
Okay, so got another question here that's sort of related, but moving gears a little bit. So why do all buyers want seller financing? Doesn't it make sense that if they don't have the cash to buy, they aren't a real buyer?
It's not necessarily that they don't have cash to buy. It's that I want to make sure that you've got some skin in the game going forward, right? If you're just looking to dump and run, then how do I know what I'm buying isn't just isn't a dud, right? Because if I'm acquiring a business that is based on relationships and contracts, and when those contracts expire and those relationships go somewhere else, and I lose all those customers, I bought nothing, right? So it's important for me to know that you have some skin in the game going forward. And not everyone wants seller financing, right? There's a lot of deals that happen where, honestly, I don't care if you stick around or not, I'll buy the whole thing lock, stock, and barrel. And that happens quite a bit. Most of the time, the seller financing piece is more the MSP the private equity groups want that person to stick around for some period of time. So if I want you to stick around, I want you to have some skin in the game. But if I can merge this in and I don't need you, most likely seller financing is probably negotiable.
Yeah, I'd say over half of our deals, the owner doesn't stay on. I mean, it's, a lot of times they're at the end of their career, and they don't have a family member that's taken it over, and they just want to sell it to a good company. They don't stay on after it. And then the way we mitigate some of that risk, Josh, is around, sometimes there's earnouts, right? So, what you said held true, you get the end of your deal. So
we have seen in this COVID period a little more difficulty getting bank financing for some of these deals. So I think in the last 12 months, there has been certainly some cases where seller financing was critical to make a deal happen because they just couldn't go to a bank and get the funding. So banks are a little gun shy on a lot of things right now. So that may be driving some of it.
Well, and that's a good point as well too. And it's incredible how simple this advice is, and yet almost nobody follows it. Is buy low, sell high, right? So a pandemic may not be the best time to try to unload your business. You may not get the multiple that you want, during a global pandemic, right? That's just my instinct. So if you can wait a little bit, and things come out of it, that might be an opportunity to get a higher multiple as well too. So macroeconomic conditions matter, right? There were a lot of businesses that wanted to sell in 2008 during the financial crisis. Not a good time to sell your business, right?
Yeah, I think that's largely true. But
Okay.
If you had a good revenue mix, meaning things were under contract, your customers stuck with you, they didn't ask for credits, they didn't ask to get out of it, you didn't have a high attrition rate in term. Those are all things that, we're buying businesses right now, right, as an acquirer. And if they showed that, hey, they're recession proof, that's a good deal, right? That helps to build value to those organizations as well.
But to Josh's point, and Clay, I want your answer on this. What's taxes going to do? If they're going to go up, now might be the right time to sell a business before that transition occurs. And that's where all these macroeconomic things really become a consideration is, how quick do I need to push a sale so I beat the tax increase, if that's my perspective, versus wait for the pandemic to go away so that we've got a more stable situation.
Yeah, we had a lot of activity before December 31st, right? So it is always the geopolitical stuff it's a factor that you just gotta consider. I guess that's all you can say about it.
All right. So then there's another question here, and I think it ties into what you're just saying because the taxes and the timing with the pandemic and all of that. So Larry asked, so is an 800K MSP just not worth trying to sell?
No, I wouldn't say that's not worth trying to sell. I think there's fewer buyers out there potentially for $800,000, right? So there's a buyer out there. They're just not as many, right? And it's a different market. And the reason goes back to what I said earlier is it takes the same amount of time, effort, and money to buy an $800,000 MSP as it does to buy an $800 million MSP. So, I'm going to look for the bigger deals. And it also depends on who the acquirers are. Years ago, when I was at Rackspace, we started to look to acquire businesses. And we ended up not doing any because we were growing faster than most of the size of the businesses we were looking to acquire on a monthly basis. So it got to the point, it just wasn't worth our time and effort anymore. Now, look, $800,000 is nothing to sneeze at. It's a decent sized business. And I do think there are plenty of companies out there that might be willing to go, but it's a different market necessarily than if you had, an $8 million MSP.
Oh, and that's where identifying the right acquisition target is going to make sense, right? If you're an 800K business, you might be looking for somewhere in the $2 to $5 million MSP to acquire. But if that's kind of not your thing, you've got other options to try and make it a more acquirable, there's the word, business, right? And this is where you see some of those groups where you have 3 or 4 MSPs that are 500 to 800K or even $1 million in revenue merged together to have a smaller piece of a bigger pie that then they can prove some growth out, some synergies out for another year or two, and then approach a company or be ready to be approached as a larger exit.
Yeah, that's been happening more and more in the last year or two. And even in larger companies, I've seen several, 5 million plus MSPs come together and create a bigger bucket of EBITDA dollars because that's what people pay for, and that's where multiples begin to go up. So there are ways to make it happen. You just have to really, again, understand what the market's doing and look for those opportunities to make it realistic for you.
And this is where a business broker or even an investment banker really can help find those acquirers for you. And I think if you're in the 800K range, it's probably more in the business broker world because they tend to deal with smaller type companies. Not that 800,000 is a small company. It's just in the world of acquisitions, it's on the smaller side. If you're much larger than that, that's where an investment banker might make sense because they have different networks. But ultimately, I think a business broker is a lot like a real estate agent, to use the sort of the analogy earlier. I mean, really what they're doing is they're putting together the brochure on your business and then getting it out to as many people that they know are actively out there looking as possible and hoping someone bites, right? I mean, that's a lot of the work that these folks do, is to sort of gin up some interest in your business. And that's really difficult to do on your own. I know going to the events and having conversations will be great. And you can shortcut 2-3 years of doing that by hiring someone. And it's all a time value of money, right? Time value of money is very important. If you're willing to wait, you can get higher value. But if by waiting, it ends up, a dollar later is worth less than 50 cents today. Okay, well then take the 50 cents today. I mean, you've got to understand the relationship there between time and value for you. And then, look, at the end of the day, the emotional piece is probably the most important piece, because if you have a business that you built from the scratch and you're looking to sell it, whether you believe it now or not, when it comes to time to sign that on the dotted line, it's going to be an emotional moment for you. And if you haven't dealt with it, it's going to be an inhibitor to getting to the financial outcomes that you want.
Okay, and then one more quick question while Josh is pulling up those last two slides so that I can tell people where to find us and all of that. Roger's asking, where do you look for the market for that 800K business? So I guess he's asking, like, how would you find?
Well, that's where the business broker comes into play. They'll help you find that. And look, at the same time, the MSP space is a fairly tight-knit group of people. I mean, most people know people. I mean, it's not like there's some big MSP hiding in the wings that no one's ever heard of that's going to come out of the walls and start acquiring businesses. I mean, we all know who they are, right? So I mean, just put yourself a list of folks that you think are worth talking to and talking about, and go out there. I mean, that's where this is helpful, right?
And a quick tip on that: go to channel-e2e.com. They track every single MSP acquisition for the last several years. You can see who the acquirers were, how many companies they've acquired, maybe a guess of multiplier. Probably a good place to start.
That's great advice. Any closing thoughts, Arlen?
I would just encourage people to get involved with communities. I mean, there's a vast amount of knowledge and information there, and people are willing to share. So, love to have them involved with IT Nation and Evolve. But, there's lots of great communities out there that people can get involved and learn from.
And how about you, Clay? Any last little words before I talk about
I think if you're looking to sell your business, get the word out. Because there are people looking. I mean, half of our work is finding businesses to buy. And if we can cut that work out because somebody comes to us, we're gonna give it a valiant effort. So just get the word out, let your vendors know, let your network know that you're interested in marketing your business, and a buyer will find you.
Very good. Well, thank you so much. Just a complete wealth of information between the four of you. And this has been so fun. I don't even think y'all needed me here today because you were just like bringing up the next topic that I kept trying to bring up. It was fantastic. Liongard, we'd love to help MSPs learn. And we do have another one coming up here March 10th, using reports to increase your profits. And of course, if you want to learn more about us, go to liongard.com. And I'm sure our wonderful panelists would be happy to connect with you on LinkedIn as well. All right, everyone. Thank you so much for an awesome panel, and we will talk to you soon.
Thank you.
Thanks, everyone.
Cheers.